So this is the second part of the video for national income. As in the first part, we discussed about some various concepts of national income and we learned about what is actually national income and the concept of macroeconomics. Now, in this second part of the video for national income, we'll be learning about circular flow of income and the other various things like different methods to estimate or calculate national income. So let's begin and understand what is actually circular flow of income. This is basically under two sector model. Now, as we know that our economy is divided into four sectors: household, business, government, and foreign sector. So as of now, since we are talking about two sector model, so we'll be including only household sector and the business sector. Household sector consists of the consumers and business sector consists of the producers. Now, as we know that the factors of production like land, labor, capital and entrepreneur forms the basics of national income. They generate the income, right? And producers need these four factors of production. So the question comes, who provides these factors of production? So as you can see the arrow, household sector, right? So household sector are the owners of factors of production, that is they provide the land, labors, capital and entrepreneur to the business sector. Now, since household sector is providing the factor services, so obviously the payment has to be made, and the payment will be made by the business sector as known as factor payment to the household sector. Like on the land they will be get land on the they will be getting rent. To the laborers they'll be providing the wages and salaries. On the capital the interest, and to the entrepreneurs the profits will be generated, right? So the household sector provides the factors of production to the business sector, and business sector makes the payment in return for their services to the household sector in the form of factor payment. Now, using these four factors of production, the business sector provides goods and services to the household sector, obviously, because ultimately the household sector will be using or consuming these goods and services produced by the business sector. Now, since these goods are not available free of cost, monetary value is there which has to be paid. So the household sector, because they have to consume the goods and services, so they make payment to the business sector in the form of consumption expenditure. Okay. Now the other two aspects of the entire circular flow of income is the real flow and money flow. So the real flow talks about basically the physical flow of factors of production to household to business, from household to business, and physical flow of goods and services from business to household, as the arrow shows. And the second is the money flow or the monetary flow, and this is what consists, since the name itself suggests, it talks about the money. It includes money, the monetary payment. So since business is making payment to the household for their services in the form of factor payment, and the household is making payment to the business sector in the form of consumption expenditure. So as the arrow shows you, this is known as money flow. To learn more about the difference between real flow and money flow, let's talk about. So the real flow, as we have already discussed, is the flow of factors of production from households to business and goods and services from business sector to household sector. While the money flow talks about the flow of factor payment from business to household and consumption expenditure from household to business sector. Now, real flow includes only the physical flow, therefore, it is also known as physical flow, and it does not include any kind of monetary transactions. While on the other hand, money flow includes the money transaction and it is called as nominal flow. Moving on, um, talking about some basic formulas. So, this is what I call as the pillars of calculating or estimating national income. So, to understand and to solve the numericals of national income, you need to have these three basics. These are the pillars. So, as in the previous video, when we talked about gross and net, right, market price and factor cost, then this is what it is discussed here. As you can see, the first formula is gross is equals to net plus depreciation. Gross investment is the total investment, therefore it includes depreciation. While when you need to calculate the net value, you will be excluding or deducting depreciation from the gross investment. The second pillar, which I say, is talks about the market price and factor cost. Now, obviously, we know this thing that market price will always be greater than the factor cost, right? Obviously, a seller will be selling a commodity which he has produced at a much greater price or greater value as to what the cost of production has been, right? Because he has to earn profit, he has to have that profit margin. So market price is always greater. So just know this fact. It's a trick that with whatever out of the two things is greater will be using the plus sign, and something which is less in the context will be using the negative sign. So since in the gross you see it is actually greater than the net, it talks about total value, so we have used plus depreciation, while in the net we have used minus depreciation from the gross. In the same way, market price is greater from factor cost, so we'll be using factor cost plus net indirect tax, while factor cost is less than the market price, so market price minus net indirect tax. And what is net indirect tax? It is actually the difference between the indirect tax which is paid to the government, deduct minus subsidies which is provided by the government to the sellers. Okay, so the difference between the IT, that is indirect tax, and subsidies is the NIT, net indirect tax. Coming to the third thing, this NNPFC stands for net national product at factor cost, and this is what we call, or is an abbreviation of national income. So when we say national income, it means NNP at FC. And when we say domestic income, this is NDP at FC, that is net domestic product at factor cost, right? So obviously national income will be greater than the domestic income. So just like I told you, we'll be using plus sign for the greater and minus sign for the lesser. So NNP at FC, national income, is greater. So NDPFC, that is domestic income, plus NFIA. NFIA stands for net factor income from abroad. While domestic income is obviously less as compared to national income, so we'll be using minus sign. So it's like NNPFC, that is national income, minus NFIA, net factor income from abroad. Now, what is net factor income from abroad? It is basically a difference between the factor income which has been received from the rest of the world minus the factor income which has been paid to the rest of the world. So moving on with the video, these are some aggregates of national income like GDP at MP, gross domestic product at market price, NDPFC, just like I've already told you, domestic income, NNPFC, net national product at factor cost, which is also called national income. Then you have GDPFC, GNPMP, GNPFC, NDPMP, and NNPMP. These are some aggregates which we'll be using in national income. Now, the most important part, methods of measuring national income. We basically have three methods of measuring national income. The first is the value added method, or it is also known as product method. The second is the income method, and the third one is the expenditure method. These three methods are basically used to estimate national income of any economy, you say. Let's talk about the first method, that is the value added method, what it is all about. So it is also called, as like I told you, product method. It measures the national income by estimating the contribution of each producing firm in the domestic territory of a country in an accounting year. Talking about the steps to calculate national income using this method is, first of all, you will be calculating value added from primary sector. Primary sector includes the agriculture. Then value added from secondary sector, which includes the manufacturing units like factories and all. And value added from tertiary sector, which includes the services sectors like banking, insurance, advertisement, communication, etc. Then summing up all the value added from all these three sectors, primary, secondary, and tertiary, we get value of output, right? And then from this value of output, you deduct the intermediate consumption from value of output to arrive at GDP at MP, that is gross domestic product at market price, right? And then you deduct depreciation, you add NFIA, and you deduct NIT to arrive at national income from GDP at MP. National income is NNP at FC. And this is the main formula of value added method, that is GDP at MP is equals to value of output minus intermediate consumption. I'll just tell you more about this entire formula. See, as you can see on your screen, GDP at MP, value of output minus intermediate consumption. This is a basic formula of value added method. Now, what is actually value of output? It is the sales. And intermediate consumption refers to the purchases of raw materials which has been done by the seller. So for example, if you have a shoe manufacturing company, right, you'll be the final product will be shoe. So the market price of shoe will be, which you have actually sold or you're about to sell, will be the value of output, right? And when you have purchased the raw material, let's talk about leather, thread, whatever it is, right? So using these raw materials, you must have purchased that. So whatever the cost you have, whatever the payment you have made for the purchasing of these raw materials, this is known as intermediate consumption, right? Sometimes value of output is equals to sales, but let's say you were not able to sell the entire out units of output in the very same year. Some of the units have been left, right, at the end of the year. So that particular portion will be known as change in stock. And how do you calculate change in stock? It's simple. Closing stock minus opening stock. Now, important things which you need to know, that what are the items you will be including while estimating national income under value added method. The goods for self consumption will always be included, since you have added something to the flow of goods and services, right? Then any public goods which are provided by the government, and an imputed or estimated rent of owner occupied houses will be included in estimating national income through this method. Now there are certain items which are to be ignored or excluded while calculating national income through this method. These are any illegal activities like gambling, smuggling. All these activities are not to be included if the income is being generated from these activities, since they are illegal in nature, so they cannot be included in national income. The second thing are the raw materials. As we already in the formula, we deduct the value of the purchases of raw materials, that is the intermediate consumptions. The third is the services provided by housewife or any other family members, since they are not considered a part of factor of production, mind it. And the sales and purchase of any second hand goods. Why? Because since at the time of their production, when they were produced for the first time, their value has already been added in that particular year's national income, so we will not be included in any other year of national income while calculating it. So any value of second hand goods is not included. And finally, any windfall gains, that is any income which has been generated from lottery or horse races, again these are not considered to be adding to the current flow of goods and services, though, so therefore they will not be included in the national income. Moving on. Now, this is an important aspect which you need to know, that what is double counting error, what it is, what is the problem of double counting. See, double counting means counting the same output two times while measuring the national income through product method. Just like Abhi, I told you, for the second hand goods, the sales and purchase of second hand goods will not be included in the current estimation of national income, because whenever they were produced for the first time, their value has already been added in that year's national income, so they will not be included again, right? So they'll be showing actually an overestimation or a false figure. So this happens when the value of raw materials and the price of the final good which is to be sold in the market is taken, right? Therefore, to avoid the double counting error, we should consider only the final value or the market price of the final good. Now, other aspect says that we do not include the value of intermediate goods. In the formula itself, we were deducting it from the national from the value of output. Why? Because when you will be producing a final output, the value of the or the cost of production will be included in the monetary value or in the market price of that output. So if you are gonna add the value of intermediate goods or the raw materials, then they will show you a false figure. So this is what actually a problem of double counting error means, right? Then moving on, the second method is the income method. It talks about how do you calculate national income. But before that, unlike in the value added method, we were calculating the GDP as the base for the national income. Here in income method, we will be calculating the value of NDPFC, that is a domestic income, as a base for calculating national income, right? So NDPFC is equals to compensation of employees plus operating surplus plus mixed income. So whatever the sources of factor income are, they will form a part of income method in national income. Okay. Now, what is compensation of employees? So, what are the components of compensation of employees? Number one, wages and salaries in cash, plus wages and salaries in kind, plus employers' contribution to social security schemes. Now, wages and salaries in cash means whatever the money, cash you receive in hand, cash in hand, the salary in hand which you take home. Then wages and salaries in kind means the other fringe benefits which you get from your employer, right? Like housing, or car or anything else which has a monetary value. Then the third is the employer's contribution to social security schemes, just like your PF, gratuity, all these are added. Then operating surplus. Now operating surplus includes rent, royalty, interest, profit. Rent is on land. Royalty is basically when you have, it's actually the income which is generated when you allow a certain person to use your asset, right? So you charge for that. Then interest on capital, and profit to the entrepreneur, but profit has three parts again. Out of the profit, first of all, you pay the corporate tax or the business tax, or you can say company tax. Then the remaining amount of the profit is paid in the form of dividends to the shareholders. And finally, if any amount of the profit is being left, then that is saved for the future use by the company, which is known as retained earnings. The other name for retained earnings is savings of private corporate sector or undistributed profits, right? And then you have mixed income. Mixed income is basically that area of income, you know which is kind of scattered. So whatever the other form of factor income are, we just group it into mixed income. The final method is the expenditure method. Now, through this method, we calculate the base GDP MP, and then we move on to estimating national income. So, the formula for calculating national income through expenditure method is GDP at MP is equals to private final consumption expenditure plus public final consumption expenditure plus the gross domestic capital formation and plus net exports. Now, every aspect or every component of this formula holds an important value. Private final consumption expenditure simply means that any consumption expenditure which has been done by both households and business on the final goods, this is private final. Any consumption expenditure which has been done by the government on the final goods and services, that is public final. The gross domestic capital formation simply says that it is a sum of gross domestic fixed capital formation plus change in stock. The only difference here you can just know is that gross domestic fixed capital formation refers to the investment which has been made into the fixed assets in a year, and change in stock is basically the current assets which we talk about, right? Then the net exports is basically the difference between the exports and imports of a country. So when you sum up all these four components, you arrive at GDP at MP, and then you can move on to calculate national income, that is NNP at FC, by just subtracting or deducting depreciation, adding NFIA, to arrive from domestic to national, and to arrive from MP to FC, deduct the NIT. So this is all in the part of national income. Hope you have understood. Thank you.